In 1929, a schoolteacher from Ohio named Mary Smith had saved $6,000, nearly a decade of wages. By October, she had turned it into $22,000 in the stock market. She felt wealthy. She felt wise. She felt like the new economy had finally chosen her. By November, she had $800 left. By 1932, she had nothing. Not because she gambled recklessly, not because she ignored the warnings, but because she did exactly what everyone told her to do. She believed in the golden 20s. This is the story they don't teach in economics class, the story of how a decade of prosperity became the greatest wealth destruction ordinary investors had ever experienced. Not through war, not through famine, through optimism. Welcome to the financial system. Control the money, control the history. And remember, simple is never easy. The 1920s didn't feel like a bubble. That's the first thing you need to understand. Bubbles only look obvious in retrospect. While you're living through them, they feel like progress. America had emerged from World War I as the world's creditor. European powers owed billions. Gold flowed into American vaults. Factories hummed with electricity, a new technology that was transforming everything. The automobile industry was creating a mobile nation. Radio was connecting millions. It felt like the future had finally arrived. And the stock market reflected that optimism. From 1921 to 1929, the Dow Jones Industrial Average rose from 63 to 381, a six-fold increase in just 8 years. Newspapers called it the new era. Economists called it permanent prosperity. And ordinary Americans, for the first time in history, were invited to participate. Before the 1920s, stocks were a game for the wealthy. You needed significant capital, connections to Wall Street, and nerves of steel. But brokers discovered something powerful. If you let ordinary people borrow money to buy stocks, everyone makes more money, at least on the way up. This was called buying on margin, and it changed everything. Here's how it worked. You wanted to buy $1,000 worth of stock, but you only had $100. No problem. Your broker would lend you the other $900. You put down 10%, borrowed 90%, and suddenly you owned 10 times more stock than you could actually afford. If the stock rose 10%, you didn't make 10%, you made 100% on your original investment. Factory workers were suddenly making more from their stock portfolios than from their wages. It felt like magic. It felt like freedom. It was a trap. By 1929, total margin debt in America equaled the entire federal budget. Think about that. Ordinary citizens owed as much in stock market loans as the government spent in a year. Teachers, clerks, mechanics, farmers, all leveraged like modern hedge funds. And here's what nobody explained. Margin works in reverse, too. When stocks fall 10%, you don't lose 10%. You lose everything, because the broker who lent you $900 wants his money back. He doesn't care that the market dropped. He issues a margin call. A margin call means deposit more cash immediately or we sell your stocks at whatever price we can get. If millions of people get margin calls at once and they all have to sell at once, prices don't decline gradually, they collapse. The market becomes a one-way door, everyone trying to exit at the same time. And the people who bought with 90% borrowed money, they're not just losing their profits, they're losing money they never had. They owe more than they started with. This is the mechanism they never tell you about. The 1929 crash didn't just erase paper gains. It created real debts that ordinary Americans would spend years trying to repay. Some never did. They lost their homes, their businesses, their futures, all because they trusted the system that told them to invest. The numbers are devastating. From September 1929 to July 1932, the Dow Jones fell 89%. $30 billion in stock value was erased at a time when the entire U.S. GDP was $103 billion. Nearly a third of the nation's wealth gone.
And the recovery? 25 years.
The market didn't return to its 1929 peak until 1954. Here's what makes this story truly bitter. Not everyone lost. In fact, some people made fortunes. In the summer of 1929, while newspapers printed stories about endless prosperity, something quiet was happening. The Morgans and the Rockefellers, the families who had built American finance, started liquidating their stock positions. They moved to cash. They bought bonds. They prepared. Bernard Baruch, one of the richest speculators in America, was almost entirely out of the market by September. Joseph Kennedy, yes, the father of the future president, sold everything that summer. Legend says he sold after his shoeshine boy gave him stock tips, but the real reason was simpler. He had connections inside the banks. He knew what was coming. These men didn't predict the crash because they were geniuses. They predicted it because they could see what ordinary investors couldn't. The debt levels were unsustainable, the concentration in a few glamour stocks was extreme, and the smart money was quietly heading for the exits. Radio Corporation of America, RCA, was the superstar of the decade. It had risen from under $2 to over $500 in just a few years. People didn't understand radio technology, they just knew the stock kept going up. RCA alone represented a huge percentage of the market's total value. When RCA cracked, the whole market cracked with it. Concentration plus leverage plus a loss of confidence. That's the formula. That's always the formula. The smart money was already in cash. Regular Americans were the exit liquidity. No story captures this tragedy better than Irving Fisher. In 1929, Fisher was the most celebrated economist in America. A professor at Yale, author of dozens of books, a pioneer in mathematical economics. He was wealthy, respected, and absolutely certain that the American economy had entered a new, permanent phase of growth. On October 16, 1929, just 8 days before Black Thursday, Fisher declared publicly that stocks had reached a permanently high plateau. He called critics like Roger Babson prophets of doom. He mocked their caution. Fisher wasn't just talking. He had invested his entire fortune in the market. He had borrowed heavily to buy more. He believed his own analysis with the confidence only an expert can have. By 1930, Fisher was broke. Not just paper losses, actual ruin. He had to sell his home. He borrowed from family. He spent the rest of his life trying to recover financially and intellectually. He never did. He died in 1947, his reputation destroyed, his fortune gone. The difference between Fisher and Babson wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. Fisher trusted the narrative. So what actually destroyed these investors' wealth? It wasn't the crash itself. Crashes happen, markets recover, eventually. What destroyed wealth was the combination of three forces that always work together. First, leverage. When you borrow to invest, you're not just betting on prices rising, you're betting they won't fall by more than your cushion. In 1929, with 10% down and 90% borrowed, prices only needed to drop 10% to wipe you out completely. They dropped 89%. Second, concentration. When everyone owns the same stocks, the RCAs, the glamour names, there's no diversification. When those stocks crack, everything cracks. The people who thought they owned the market actually own a handful of bets. Third, timing. The people who bought at the peak of 1929, even without leverage, had to wait 25 years just to break even. A generation of retirement savings frozen in time. The cruel mathematics of percentage loss. If you lose 89%, you need a 700% gain just to get back to where you started. The golden 20s didn't just destroy wealth, they destroyed time. Here's what should keep you awake at night. Every element of the 1920s disaster has repeated since then. In 2000, it was the dot-com bubble. Ordinary investors pouring savings into companies with no profits, convinced the new economy had changed the rules. The Nasdaq fell 78%. In 2008, it was housing. Families borrowing to buy homes they couldn't afford, convinced real estate always goes up. Millions lost everything. And now, look around. Margin debt near historic highs. A handful of mega-cap stocks dominating index returns. Ordinary investors told that the market always goes up in the long run. The names change. The mechanism doesn't. The golden 20s didn't destroy investors' wealth because it was a uniquely dangerous era. It destroyed them because optimism became leverage, leverage became fragility, and fragility met reality. History doesn't repeat, but it rhymes, and this rhyme has a body count. If this gave you a new perspective, hit subscribe. Its financial system and history leaves clues. I show you where the money leads.